Well, good morning. It's May 15th. Hope everybody had a great Mother's Day weekend. Wanted to catch you up to speed to the latest data here in the Austin market. This is a look at a couple pieces of data that we just got in this last week. The data in front of you, this is breaking down. This top box is the 5-county metro area, looking at April of 2023, and the second column over April of 2022 last year, which was right when we were kind of already starting to slow down. But on median home price, we were peaking out in April and May of last year. So we're going to look at that data. And then in the bottom column, that's just the city of Austin. So breaking that out. So if we look at total sales for the metro area, we're down in April 25%. So only 3 out of every 4 sales that would have happened last year are happening now in April. And if you go to the city of Austin, it's even slower. We're down 33%. So only 2 out of every 3 homes are selling now compared to what they would have done last year. New listings, though, are not that different, maybe down 11%, not as bad, but in the city limits, it's pretty equal. We're seeing almost the exact same number of listings as we would have seen last year. So that's pretty much the same. In terms of average sold price, we're down about 12.4% in the market, 15% on the median. I like to look at the median. I think it's more accurate. So anyways, about 15%. This is where you're starting to see the big gap between prices this time last year and prices this year. If I look in the city, we're down about 9.8% on the median. So the city's holding up a little better. I think it's for a couple reasons. Number one, we don't have as much new construction. So you don't have these big home builders with 200, 300, 400 homes they have to sell, that are having to be price competitive. You're seeing more of that on the outskirts in our suburbs. And number two, we don't have as many first-time home buyers in the city. You tend to have those more, again, in those more affordable price points in your outer suburbs. So they're more likely seeing a little more pain in those outer areas because affordability in terms of that mortgage rate really making an impact. But the city's not immune. They're also seeing some price decline. Days on market, last year, obviously, we were under a month of inventory at this time. Now we're approaching about 4 months, depends on what data you look at, but 3.5 to 4 months of inventory. Same in the city. So we're seeing the same thing there. All right, so that's some April data, and that's looking at April 2023 versus April of last year. I've got some different data here that I want to look at. This is from the Austin Board of Realtors. And before you kind of lose your mind looking at all these different things on the screen. So this is now looking at March 2023, 2 months ago, to April 2023, 1 month ago. So now we're just looking at month over month this year. So if we look at March, median sales price was coming in at $450, and that was down 13% over March of last year. Then it went up. So for the metro area, we've seen $450. It went back up to $466. You're getting a little bit of that spring bounce. So March to April this year, you're seeing a little more increase in the median price, but it's down 15% over this time last year. The big gap is going to be when we get to May and June. So that's coming up. Just know our biggest price decline year over year is coming up. We're going to see because it peaked out May and June of last year. By then, the interest rates had already spiked way up, but those sales from the spring were finally closing. And then you really see the price start to drop hard last fall. So we'll see that data later this year, but the big drop is coming up May and June. In terms of days on market, we had 80 days on the market in March. It's gone down a little bit. We're down to 71 days. And then 3 months of inventory in March. We're at 3.2 for April. So that is the total metro area. Let's go to the city of Austin. I'm going to pull that up here. So this is now, again, March to April, just in the city. Median sales price was $529 in March. Now it's $565. Again, getting that spring bounce. And that climb in the city actually lowered a little bit the gap between this time and last year. So that was a little surprising, but still down 11% over this time last year. Days on market dropped from 66 to 48 days, March to April. So again, seeing more buyer activity in the city. And then months of inventory is up 2.8 to 3.2 months of inventory. So right now, we're looking at April closings were from February and March buyers, which says that that kind of spring wave picked back up as we got into February and March. I wouldn't be surprised if we see healthy numbers of sales, median home price kind of holding up as we see May data come out, maybe even June data come out. So we're going to be looking for that. But then just know it always tends to slow down. We have our peak number of sales as we get through June, and then it just starts to taper off as we get through the second half of the year. There's usually fewer sellers the second half of the year, and there's also fewer buyers. So some of it's just the volume of activity tends to slow down. I did want to share, let me pull it up, mortgage rates. All right, so here's where we are this week. We're still holding steady in the mid sixes. So as we look at the rates right now, you're still, again, a 6.5 rate for a primary home buyer. Some of the builders in the suburbs are offering incentives to help people buy down those rates. So I've got clients that can find deals locked in at like 5.5 with some of the builders that have bought interest rate packages kind of in tranches. And there's also builders might do a 3-2-1 buy down or a 2-1 buy down for buyers, which means they can take that 6.5 and maybe the first year they buy it down 2 points. And that buyer's only going to pay 4.5% for the first year, 5.5% the second year, and then it'll move up to the 6.5% by the third year. And buyers might take that bet because they'll think, hey, in 3 years, maybe in that time interest rates come down, I'll just refinance. So that's where we are in rates. I want to show you this chart. So this one I pulled up this morning. So this is averaged 30-year fixed rate mortgages. This is going back into 2009, okay? So if you look at this line right here where it says 6%, only at the very end have we been now over the past 10 months plus, have we been over and steadily over 6%. If you go back in 2002 or 22, we had 2.97. This is August 2021. Even in the peak of 2018, we went up to 5. People thought that was hard at that time, but really 4s, 3s, 4s, 3s, 4s, all the way back. So really what's happened is we've now spent 12 to 13 years where 5% and below was the norm. So you have 12 years of selling activity. Every mortgage you see is most likely for homeowners locked in below 5%. I think the statistic is over 70% is below 4%. And even 50% is below 3%. I mean, you've got people with super cheap debt on their homes. One of the reasons we're not going to see this big wave of inventory of all these sellers coming out is because how many sellers want to trade their mortgage from a 3% to a 6.5%? Because to become a buyer, you have to be a seller many times. Obviously, renters don't care. But if you already own a home, you've got to make that decision to go, oh, am I really going to sell a house where I have a 3% mortgage rate? I might even want to move up to a bigger house and have to put a higher mortgage on it. What's happening is a lot of sellers are not making that move. That's keeping inventory tight enough that it's helping hold up the price. So that's what we're seeing in the market right now. Now Austin's been nationally one of the ones that has seen more inventory, but just on a high level, we're not seeing, what would collapse the market, which would be a rush of sellers. Ironically, if mortgage rates come down, let's say into the mid 5s over the next year or 2 years, that might start to unlock some more of those sellers who go, okay, I'll trade from a 3 to a 5. That's not as big of a deal. So I think we're going to have to wait and see right now. This kind of chart shows me that you have 12 years of buyers and sellers that are locked in at lower interest rates, homeowners locked in at lower rates. It's a hard trade for them to want to move up. And by the way, they're buyers. So if you're a seller right now, one of the reasons you're not seeing as many buyers is those buyers might have been sellers too, and they don't want to sell. And so that's why we're seeing a 25% decline in activity in the city, in the metro area, 33% in the city. You just don't have as many people trading their house to move across town. So keep an eye on that. I think the big thing we want to watch, there's probably a couple pieces of decent news and one big scary gorilla that we got to pay attention to. So right now, the Fed most likely, based on a lot of experts, is kind of where they need to be in terms of their rate. And they're now probably in a wait and see mode. That's pretty good for mortgage rates. That might hold them in the 6s for now. I think that's a good piece of news. Obviously, we've started to see the inflation data trend slowly, but it is coming down pretty consistently. The CPI's come down for 12 months in a row. I heard this morning that that's a historical record that we've had it come down 12 months in a row. So that's a good sign for inflation. The big scary gorilla is the debt ceiling debate that everybody's watching in Washington. Nothing I can do about it, but just know I read a report from Zillow. If we hit the debt ceiling and we don't solve it and it blows up and we go into default, mortgage rates could go from 6.5 to 8 or 9. And so like that, because everybody's going to lose their faith in the bond market, in the debts, and they're going to want a much higher return because now they fear default. So what's going to happen is it could blow up the mortgage rates. And if that happens, it will absolutely just shock the real estate market and put things in a freeze. So let's all hope the folks in DC can find some solutions, solve the debt ceiling debate, move on. And if that happens, I think we will see a fairly decent summer. So we're watching this, keeping a track of all this data for you. Take a look. If you have any questions, please reach out to us. We'd love to do kind of a deeper discussion on this with you if you're planning to sell or buy in the near future. And of course, you can find all these videos on YouTube at Ryan Kelly Group. Search us there. Until then, hope you enjoy the lovely weather in mid-May, and we'll talk to you next week.